Hello and welcome to another part within the Fibonacci video, as well as a continuation to the most recent video. And we're going to go more towards the retracement. In the last Fibonacci video, we talked about the calculations for getting the percentages for each one. You take the log level of its current price from its lowest price, you divide it from the log level from the high and the low, and you get this percent. Generally speaking, using Fibonacci, if you're over 61.8%, then that would be bullish, but only a little bullish. At 76.4%, it's pretty nicely bullish. 85.4 extremely bullish, and then once you get in past 90.1 or just a rough 90%, then it's very, very bullish. And anything above the 95, 96, it's just going vertical, at least at that time frame. Okay, so what we're going to do is we're going to take a look at this in more depth, because you look at these numbers. Okay, so yes, it tells me that it's bullish, and well, it's telling me that the long-term stuff, the month, quarter, and half year are good to go. Weekly's doing fairly good. The daily or the 3 days doing decent. The daily needs to pick it up, and the 6 hour is, well, at least it's above 50%. Okay, so we're going to take a look at some previous dates, because I can bring this back to the fall of 2008. And this is what we have. We have the daily time frame, the 6 hour, the 3 day, the weekly, the monthly, the quarter, and the half year. And we'll put this in a chart format. We'll take a look at what because this is the, one of these is the average in here. And we're going to take a look at the average, which is right in here. This is the average of silver going back from that time frame in 2008. So what does this chart tell us? Well, we've got this nice trend line that went higher in here, just a pattern of higher highs. The lowest point we have is 60%. So basically, staying above this keeps it bullish, which it has done so. We have this point in here. We have never been this bearish, or this was the lowest level since the summer of 2010. That was a different time frame, because yes, there was more selling today, but the market didn't have the bullish moves back then, because it was only $20, not even that, $16 per ounce, $17. So it really wasn't doing so well in the long-term time frame. We'll get more into that, but as far as what we're seeing here, maybe this thing can break in and start to go higher, because we did find support at the 61.8. It's tough to state, but a lot of times those levels do work. This is where we're at right now. This is another way of looking at this. The blue line represents the daily chart, or the last 100 days, and the red line is the very short-term charts. This I got some notes on some of them, so I'm gonna have to switch over to take a look at them. But there's a lot of these charts. What do we see here? Well, we're seeing how a lot of these upper bands are staying within it, and we're only getting a correction within the short term. Okay. This chart here represents what the silver price looked like as it was doing its fall crash. It was extremely embedded or crunched to the top end, because when you're at the very top of this, that means every single time frame is at 100%, which is telling us that every price is within its period highs. And when the market was up to $49.80 an ounce, that was exactly the case. Price action had us at the highs, thus this came into play. And when the market sunk down, only the two levels went below the 61.8. That was the daily and the quarter day. So the long-term trend never got destroyed in here. Merely, this was showing us a correction. Next one. This will take us back to, just move this in here so I can see what this says. March 11th to April 22nd. So this is what took us towards the bull market. We have here the moving average, or the charts just really having a nice ride to the upside. The lowest level on here is 60%. So even the short term is not leaving the bullish level, because that's really important to know, because if we put this at a 0% level, we can see clearly just how embedded these levels are. If you're very familiar with an embedded stochastic reading, it's a very similar type of thing here. These levels are embedded at the top and very bullish, and the short term really wasn't showing much of a correction, just the decent small amounts along the way. Okay, the next chart. This one had a big rise from the zero level. When did this occur? This was the January bottom of this year. So in January, when we had our selling, no trend other than the short term was violated. The daily wasn't, because it stayed above 61.8. And then after it started to rally, everything started back in the embedding process. This one here happened right before it. So before the market ended up having its bottom point, this was the January selling, that is. Again, you see nothing here to signify that the bears are taking control. This chart here represents the, let me again move this so I can read it, the fall 2011 rally. This would be October, November type time frame, and again, only the short-term level goes below the 61.8, and it barely does it because it's 40% as a bottom. That's very bullish. What's this chart in here? This is early September. So as the market was originally rallying, we were seeing here that things were getting very good. Now this orange line. Now what's this one here that's lagging its way up? Well, that's the longer term trend, because it was still well below the $50 highs, as was this one in here. So therefore it still had a little bit of work to go, and well, that should have been a telltale sign right there that it's extremely early in the process, and it still is. We'll get more into that at the conclusion of this. This chart here represents how the rally begun. The rally begun back at the bottom part in this downward motion in here. A lot of these moving averages in here were below 60. Only the daily, well, only two of them, but a lot of them are below this level in here, towards the 60s and the 70s. That's what I was trying to state. And it pulled off from a significant level. So as this thing's getting going here, from this sign, it's like, you know what? This should be telling you that things are looking pretty good. Now this one in here, we're going to go way back, because this is 0%. This takes us back to the range of the summer. There's not much stating here that the market is oversold. That's for most certain. The daily time, it was not bullish. The short term, it stayed bearish or not bullish for a decent amount of time. In the long term, or more longer term ones, they're still bullish, but that was only because we came back from the '08 bottom. And that's what we're going to go to now. We're going to go to the 2008 fall bottom. This is how the market looked in 2008 with $8 silver. Notice that none of these lines were above 61.8%. There was absolutely nothing bullish about silver at this time frame. And sometimes when there's absolutely nothing bullish about it, then it's your greatest buy, which it was. In order for that to be the case, you need to know any fundamental reason for that to be true, and that was obviously sure enough the case. So we see in the daily chart, it was pretty much embedding on the bottom end. The 3-day chart was embedding, and the quarter-day chart could not even really stay above the 61.8 cents in here. Nothing was really getting going in here. This was the move it took to Christmas of that year, so we're just going to keep going further within. And as the rally was moving forward, notice that It was the shorter term moves that was bringing it higher. This is the daily chart. This is the quarter day. It was bullish, but the other ones were lagging at this time frame. Again, same thing. Things starting to pick up. Now we see how, because it's picked up a little bit, that the short term having some trouble in here, but it picked it up very well. Now this one here, did I write a note on this? I did. This was June 15, 2009. What we've seen here was a down move where we had a nice little level in here. By the way, this little warning sign that just would have worked out so perfectly, yep, it did create a few more down moves, but nothing major. You can see that here, that the daily chart went bearish. That's the 38.2. Below this line is bearish. Only for a short period, though. And then it managed to get back within this range, still trying to get really bullish because nothing's above 80% except for short-term stuff. Now we can lift the lower part here to 30%. Just keeping on going. This is as the market was rallying in 2009. And there we can see here. Now finally, do I have a note on here? Probably not, no. This is where we were starting to embed over 80%. So let me just find out when this was, 279 to 309. It was embedding like this between the late part of the fall of 2009. It was showing us how it was just staying and holding above 80%, which is pretty much like an embedding process, which is just staying well within the lines. So that's where we left off, the embedment above here. And then the longer term trends are still getting going. That's a big indicator right there. Okay, wait a second here. All the short term and mid-term trends are embedding above 80, yet the long-term trends are not. Interesting. This is the start of 2009, or end of 2009, start of 2010. Market's holding up now to 61.8. Every single level, with the exception of the shortest term here, held the 61.8% level. Then came the February lows. What levels got affected? The daily chart got affected. The short term. That was about it. That was it. And then that should be about it. I know a lot of this might have been a little confusing. Only so many people have actually managed to go to this point within here, but I'm going to compare this a little bit now to some other time frames or some other markets, and then we'll even go back to this again, but different time frame, I guess. Again. All right, this is the Dow Jones Industrial Average as of a few days ago, or the day that I did the Dow Jones video. And at this point, we've seen how the short term went to a crash level big time. Now, the levels that went below 60, 3 different time frames broke below the 61.8%, and the bullish trend that we see here is still above the 80%, and it's starting to turn lower from an embedded higher level. So it's a little bit of a difference, and just going over some even older Dow Jones charts, just waiting for it to, there we go. This chart here was the market crash in 1987. So 60% in here meant that only the 3 longest term levels didn't break down. These 2 levels would have fell below 61.8 and then recaptured it because this was nothing more than a correction. Now what we're seeing here, let me just see if I wrote a note down. Nope. This is more periods. This is 140. This is definitely the 1990s. What I want to really show here is the embedding of the stochastic, well, not stochastic, the embedding for a long period. This is what the 1990s looked like on several of occasions, where you had all of these moves in here. If I just pick some random days, We'll do 13,000 instead of 14,000. I have no idea what I'm going to come up with, other than I'm expecting it to be majorly embedded on the top part. Although this one isn't as embedded, but still the longer term averages controlling this particular market. Now let's move back to silver. Okay, this didn't work out how I wanted, so now we're back and running. Okay, this is the silver market going back to 1975. This is overall average strength using the very similar kind of methods. So when it went up to 1980, 79, it embedded this top end, but only for really a few months more than anything, a couple years, and then it went down, and 38.2% is a bearish line. So look at the length and time frame this market was bearish for. Well, if we can go from period 1,000 to period 14,000, or it's really hard to read these numbers. And I just canceled it. Anyway, the move in the bearish territory was for a decent amount of time. They were back in the higher trend. It started to get up towards this 80-90% mark, meaning it was pretty bullish, but not majorly bullish, because it needs to be over the 85.4 and the 90.9% to really be super bullish. So it really found that area as resistance rather as an area where it could embed and break out from. Well, we've now managed to get there, but only briefly, much less, more brief than this one was. So therefore, if we take a look at, I'm not going to show it, but if the stock market in the 1990s was able to break past the level of their low or their highs of like 2,800 or whatever the pre-1987 crash highs were, and then just keep rolling for years to 10,000, it would have done that with a much or a very long period of embedding this higher end. Gold right now has been embedding past their levels for over 2 years. Ever since it really broke past that 1,000 mark, it's been in a extremely powerful uptrend. One day I could be able to show you that chart, but that will not be for today. This one is the long-term view. This is the one that takes the average of the last, oh man, I can't remember offhand. I did this fairly fast. I'll have to go over this chart too as well. The long-term one takes the average of about 8,000 days. So that's pretty serious. I've lost my tracking, so I just want to see where the charts are. Okay. Now this chart in here is showing, let me just do the data range for this, 3,000 to 3,036. Let me just pause and find out where this level is. Okay, this goes back, this is a 1980 top. So what we were seeing in here, this lower level here is 80%. So I think that's good to know. I don't need this section to make the chart a bit bigger. The bottom part is 80%. So if we move this to 0% again, we would really see how embedded the market was within this time frame. Maybe we'll put in some previous dates, maybe another 100 days beforehand, and really take a look at how the movements really worked. Look at this. In a period of 137 days, even the shortest of term averages never went below 70. Now, granted, this one really didn't have a quarter day. Its lowest was daily or 100 periods from its lowest point. But it really does show how nice this bull market came into play. 2,600 now. So this is what the embeddedness of this looked like. So a nice little run, a few corrections along the way, and it was doing a spectacular job. Now let's take a look at this chart today. What I got for this one is that this longer term line has finally managed to become bullish. This is the most longest of term lines. So it's at 61% here. Huge level. Huge, huge, huge level. And then it has a big move to join this embedded move. And the moment that it goes there, it has this correction. Notice that it's only the short one that's going through the 61.8%. I don't expect this one to stay along the 100% for just a day or two. I'd expect it to stay there for a decent amount of time. To me, this is extremely, extremely bullish. Okay, this is over 20 minutes, but to me, this is an amazing video. I know it's hard for a lot of people to understand, but if you can understand this, this is spectacular information. Take care.